Here is the overview of today's gold market news. Gold price performance, price trends, and technical outlook. Impact of U.S. inflation and Federal Reserve decisions on gold prices. How U.S. trade policies and tariffs are driving gold prices amid geopolitical uncertainty. Central banks, gold-backed exchange-traded funds, and global economic slowdown drive rising gold demand. Let's look at the latest gold price performance, price trends, and technical outlook. Gold prices surged over 1.00% on Thursday, reaching a high before slightly fading back to $3,046. This price movement was largely driven by fresh tariff announcements from President Donald Trump. The metal has reached a fresh all-time high and target zone of $3,080 based on several Fibonacci price levels. It recorded an intraday high of $3,086 on Friday, marking significant bullish momentum in the market. The daily close above $3,080 would signal a more bullish outlook. This marks the third consecutive week of higher weekly highs and lows for gold, following a breakout after 2 weeks of consolidation. This is supported by a rising ABCD pattern formed from December's low and the March 11th pullback. This surge is due to a combination of factors, with buyers continuing to show interest in the yellow metal. There's now speculation that gold may test the $3,100 level soon. Gold's price levels have been gradually pushing higher, and this could be a key resistance point for the metal in the near term. Over the last 12 months, gold has risen by more than 35%. This strong performance is mainly due to the aforementioned factors, which are the rising demand from central banks, trade tensions, and increasing interest in gold-backed exchange-traded funds. The continued strength of the metal is supported by these consistent trends, meaning gold could maintain its upward momentum in the future, as the demand for gold appears robust. The daily R1 resistance level for gold was broken, with the next major resistance at $3,040, near the all-time high of $3,057. The intraday support for gold stood at $3,010, with a psychological support level at $3,000, which helped to prevent further declines. Investors are eyeing resistance levels at $3,125 and $3,177 for potential further gains. If gold rally continues, it could continue its bullish trend towards resistance around $3,125, which is derived from an ABCD pattern starting from December's low. Higher levels include $3,169 and $3,177, with the latter being derived from a rising ABCD pattern based on recent lows. Analysts are predicting that gold prices will continue to rise in the coming years. For instance, Bank of America has increased its gold price forecast for 2025 to an average of $3,063 per ounce, up from earlier forecasts. They also predict a further increase to $3,350 per ounce by 2026. Goldman Sachs has raised its year-end forecast to $3,300 per ounce, citing stronger than expected demand from central banks and a rise in investments through gold-backed exchange-traded funds. Both banks have adjusted their previous price projections upward, reflecting the sustained demand and potential for gold prices to reach even higher levels in the future, including predictions of gold reaching $3,500 within the next 2 years. Analysts pointed out that gold's active June contract has remained above $3,100, and the next resistance level is at $3,150. They emphasized that various global factors are aligning in favor of gold, positioning it for further potential gains. March is likely to close on a bullish note for gold, leaving it positioned strongly on the long-term chart. The expectation remains for further price increases, with intraday weakness seen as an opportunity to buy or add positions. A sustained drop below $3,054 could signal a reversal in the bullish trend, but for now, the outlook is optimistic for higher prices. Next, let's look at the impact of U.S. inflation and Federal Reserve decisions on gold prices. The Personal Consumption Expenditures Price Index is due for release and is a crucial inflation indicator that the Federal Reserve uses to gauge inflationary pressures. This index tracks the change in the prices of goods and services purchased by U.S. consumers, and it's closely watched by investors. The Federal Reserve recently raised its inflation forecast due to the expected impact of tariffs, which has created a clouded outlook for future interest rate cuts. If the Personal Consumption Expenditures Price Index shows lower inflation than expected, it could prompt the Federal Reserve to consider rate cuts sooner, which would likely push gold prices higher due to the inverse. Moving on, let's look at how recent U.S. trade policies and tariffs are driving gold prices amid geopolitical uncertainty. The U.S. trade and fiscal policies, including tariffs and tax cuts associated with the Trump administration, are a major factor behind gold's price increase. The anticipation of further trade tensions and tariffs next week is generating risk aversion in the market. As a result of these trade uncertainties, investors are flocking to gold as a safe haven asset, traditionally seen as a stable store of value during times of geopolitical and economic instability. This is contributing to the ongoing record highs in gold prices. Geopolitical risks, such as tensions between major economies or other international crises, could further bolster gold's appeal as a safe haven asset. On Wednesday, Trump signed a proclamation to impose a 25% tariff on auto imports, which contributed to the spike in gold prices. The tariff was part of a broader strategy to bring more manufacturing jobs back to the U.S. Additionally, Trump hinted at more tariffs on the European Union and Canada, especially if they cooperate against the U.S. economy, including duties on items like lumber, semiconductors, and pharmaceutical drugs. The potential for more tariffs and retaliation from other countries made the market uncertain about what would happen on April 2nd and 3rd, leading to confusion and contradictions around the upcoming trade policies. In addition to U.S. policies and tariffs, central banks, gold-backed exchange-traded funds, and global economic slowdown are seen to drive rising gold demand. Central banks have been significant buyers of gold over the past 2 to 3 years. These institutions are diversifying their foreign exchange reserves into gold, seen as a hedge against potential currency risks, economic downturns, or inflation. Additionally, gold-backed exchange-traded funds have seen a surge in demand. These exchange-traded funds are investment funds that hold physical gold, making it easier for investors to gain exposure to gold without owning the metal directly. In February, these exchange-traded funds saw inflows of $9.4 billion, the largest amount since March 2022. This ongoing demand from both institutional and individual investors is pushing gold prices higher. A global economic slowdown is also a contributing factor. As growth slows, central banks may lower interest rates or engage in other monetary easing measures, which historically tends to benefit gold prices.